You might have heard that the government is buying billions in mortgage bonds, but what does that actually mean for you and your interest rate? When the government, or more specifically, the Federal Reserve, buys mortgage backed securities, it's trying to do one thing, and that's lower mortgage rates. Mortgage bonds are where your 30-year fixed rate mortgage ends up. When demand for those bonds goes up, the return investors' needs goes down, and that lowers mortgage rates. So when the Fed buys billions in these bonds, it artificially boosts demand. That pushes rates down, at least temporarily. This is exactly what we saw in 2020. The Fed bought trillions in mortgage bonds and rates dropped to record lows. But here's the catch. The moment the Fed stops buying, or worse, starts selling these same mortgage bonds, rates often shoot back up. This is why rates feel so unpredictable. They're not just tied to inflation or the economy, they're also being pulled around by what the Fed is doing behind the scenes. So, what should you do? If you're shopping for a home right now, don't try to time the bond market. Instead, get clarity on your monthly payment and know your break even point if you plan to refinance later. And make sure you're working with a loan officer who actually tracks this stuff, because it can impact your rate by thousands of dollars over time.